It's been a pretty crazy few days in the stock market world and here on Finance YouTube. Just last week on Thursday, the stock market had one of its best ever days. The S&P 500 over in the US rose more than 5% in a single day, and the Nasdaq, the index which focuses more on the tech companies, rallied more than 7%. Now, to put that into perspective, that's not just a great day, it's one of the best days ever that the stock market's seen. So check this out. Here's a list of the best ever days for the Nasdaq since it launched back in 1971. In green are the best 20 days, and last Thursday, that rally became the 14th biggest rise in the last 50 years. What a rollercoaster ride, and just as you thought things might have been calming down a bit, today as I'm putting together this video, we're seeing more green in the markets. The S&P 500 looks to be popping up nearly 2%, and the Nasdaq is soaring high, around 2.8% up. Now, as usual, by the time I edit the video, things will probably change and I look like an idiot again, but anyway, you get the point. Now, is it just me, or do stock charts at the moment currently look like Sam Bankman-Fried's blood pressure? They're spiking all over the place. Anyway, with everything going on at the moment, I thought it would just be a good time to take a quick pause, gather our thoughts and just have a look at everything currently going on, break things down into pros and cons, and look at whether or not this is the new bull market starting up, or whether this is just another trap and things are going to keep heading downwards. And just before we get into that, a big thanks to today's video sponsor, FTX. Only kidding, but what a mess all of that stuff is. Okay, so let's just break down everything that's happened last week. Why did the market rally? Well, seemingly the biggest news was the latest inflation data out from the US, which came in lower than expected. So in really simple terms, out of all the amazingly smart people on Wall Street who make predictions, they were wrong and it was lower than what they thought. So the number came in at 7.7%, meaning that compared to 12 months ago, what would have cost you $100 now cost you around $107.70. Now we'll look at this in a little bit more detail later, but from the expectation from the market was around 8%. So as soon as this news got released, stocks went wild, even the really bad ones that don't make any money. Now, just as soon as we thought that things were about to come back down to earth this week with some more bad news, we've seen the producer price index. Now, the PPI is important because rather than showing us what inflation is like for you or I when we go to the shops or fill up the car, the PPI is showing us what businesses are seeing. So it looks at how their costs have changed for raw materials like machinery, tools, and all of those kind of things. And this is really important because if this shows us a high number, then consumers like you and me will likely see higher prices later as those products that the businesses actually make end up on the shelves and we end up having to spend our hard-earned money on. Anyway, hopefully that all makes sense and I've explained it simply enough. I mean, at least it's simpler than the company structure of FTX, but maybe we'll save that one for another video. I have to say that mess looks like somebody combined a Ponzi scheme with the periodic table and then just dropped a nuke on it and said, yeah, that looks fine to me. Okay, so a bit of positive news for a change in the markets, and investors have suddenly realised that they actually did like the same companies that they didn't like so much just a few days and weeks ago before. I swear it's like being back in primary school where you'd have a girlfriend for a week that you'd never talk to, and then someone completely different a couple of days later. Ah, those were the days. And don't make eye contact at all, that would be weird. You just hold their hand and look away. Alright then, back on track. For us investors, does this mean that we're finally through the worst of this terrible market of 2022? And can we start to see things turn green again? Is all of that money that's been piled up on the side now ready to be drip-fed back into the beast of the stock market? Or is this a trap that's trying to lure us in? And also, if you're brand new to investing, firstly, welcome, I'll be your guide, please wear your seatbelt. And secondly, is now a good time to start? Now, just before I jump into the pros and cons breakdown, events like last week reminded me of one of my favourite bits of data that you might have heard before from other financial YouTubers, and it's all about trying to time the market, or at least showing how difficult it actually can be. Basically, if you're not invested in just a small number of days across your entire investing career, you can pretty much kiss all of your returns goodbye, and you could end up risking all of your profits. So check this out, JP Morgan ran the numbers for someone who invested from the year 2000 all the way to 2019. So that's 5,000 days worth of investing, assuming that they just threw in all of their cash right at the beginning and left it all alone. Here are the results at the end of that period. If they do nothing, they're left with $32,421. But now here's the really interesting bit. If they miss out some of the best days in the market for whatever reason, their returns really get hit hard. Even missing the 10 best days in the market cuts the return in half, and then missing just 20 days out of 5,000 costs you all of your returns. Now, if that doesn't scare you the next time you're thinking about selling everything, then I don't really know what will. After missing any more than 20 days, you can see that you end up losing money, so just be super careful with market timing. Who could have predicted a move like we've just seen from a single inflation report last week? Okay, what's looking good on the pro side? Why should we be bullish on the market right now and think we're all in the clear? Well, as we just said, the market's had one of its best ever days last week, and there is definitely some consensus out there that suggests inflation may have peaked and things should start to return to some kind of level of normality, whatever that is. Remember, one of the biggest reasons that investors were so bullish last week was because any sign of inflation going down should, in theory, be a sign for the Fed, the US central bank, to stop hiking interest rates, or not at least as quickly as they have been before. Generally, interest rates are like gravity to the stock market, as Warren Buffett reminds us. When it's high, it puts pressure on companies, so anytime we think it's heading lower, people get very, very excited. Now, I'm not going to make any kind of predictions here, but if we are through the peak of inflation and only on the way down, then you might expect things to improve. But of course, the stock market's made up of all kinds of players, so trying to play the game of time in the market probably won't end up very well for you. Secondly, if you've been paying attention to company earnings that just got reported for this quarter, at least from some of the big boys, you'd probably say that they were really not that bad at all. Microsoft's a good example. They managed to beat earnings expectations, something that's never easy to do once you get to become one of those big old giants. But even saying that, they did lower their guidance just a bit for their cloud business. But it's not like everything's falling apart and no businesses are spending money. If things were really bad out there in the economy, then you might expect big companies like Microsoft to start really missing targets as their customers, who include pretty much every major business in the world, cut back, but then you would say Microsoft is potentially an essential spend. Just sticking to earnings quickly, another pro for the bulls is Walmart's data, which just came out today as I actually filmed this video. Because Walmart's such a big company and right on the front lines of spending, they get a really good view of whether the US consumer is spending money. Now, Walmart stock shot up yesterday by 6% because of their good results. Like-for-like sales were up in their stores, and they're also stealing market share from other retailers, even suggesting that richer families are now shopping at Walmart as they feel the pinch with other costs riding in the economy. So that's another tick for the bulls that things really aren't as bad out there as they're made to be. And finally, although we can't use previous stock market history as any kind of really useful guide to predict stock market future prices, we do have a couple of things going for us if we're really long-term investors. Firstly, we've had a massive sell-off and we've been in a bear market for a lot of the year with many stocks down a huge amount. You could definitely make the argument that stocks have been sold off more than they might deserve and that there's been quite an overreaction. And then working from that point, remember that the stock market is a forward-looking beast, so although we don't know the future, it's made up of lots of guesses about it and bets on what might happen. So if I was a brand new investor right now, I know that we're nowhere near all-time highs, and if anything, this will probably be a good time to buy, as if anything, I'm looking to build wealth over the next couple of decades. Okay, that's the pros out the way. Now, what about all of the negatives? Because there's always something lurking out there ready to cause a panic. And to be honest, we're not quite out of the woods just yet. Okay, first off, inflation. We've just seen the market react to inflation data as if it's completely disappeared. And I'm not sure what planet you celebrate inflation at only 7%. That's insanely high. And if we want to get back to around 2%, which is what most central banks do, including the US and here in the UK, we've got a lot of work to do, and that will probably mean rises of interest rates and keeping them pretty high until we see things cool off a bit. The problem is the jobs market's still pretty tight, and until people really start to rein in spending and we see many more jobs losses, business is still going to be challenging, it's going to be very expensive to raise money to invest, and consumers like you or me are definitely going to be hit those higher rates if we want loans and mortgages too. Second up, I know we just said that Walmart was seeing pretty strong demand, but then they are well known for their bargains and keeping prices pretty low with massive, huge economies of scale. However, this isn't quite true across the board, and people are definitely not spending as much as they did before. A good example is Apple, and this company is so important because they're the most valuable in the world, and any signs of a weak consumer not upgrading to the latest iPhone or buying new computers could definitely have some major effects on the stock market. Now, we've got a tale of two stories here. Apparently demand for the iPhone Pro is strong, yet for the cheaper model, the regular iPhone 14 and 14 Plus, the demand isn't quite what they expected. Okay, so if I go to the UK Apple Store now and check this, I can see an iPhone 14 Pro, if ordered today, might only just make it in time for Christmas, whereas if I choose an iPhone 14, I can get it immediately from the store or even next day delivery. The big data here that we want to keep an eye on is definitely how Apple perform over that holiday period, and if it's weak, then it could certainly be a sign of things to come. And here's another major point too on data just released as I was actually putting together this video. Consumer debt in the US at least has reached some pretty eye-watering numbers. Apparently debt has increased at its fastest pace in 15 years because of big increases in credit card usage. It increased by $351 billion, which is the largest increase since 2007, and that means that the total held is now $16.5 trillion. Now, debt's fine if you can manage it and keep paying it back, but of course with rising interest rates, that debt is probably costing the average person more each month, especially on a credit card. And the moment people can't afford to pay their debts, that's when things really start to break, aka the global financial crash. This one will be a really interesting one to keep an eye on as we're seeing how many people miss mortgage payments or even car payments once those debts get too high. Okay, a couple more points to still be bearish about. One, you could definitely say that we're still not flushed out all of the clown stocks in the market. So that's companies who are burning cash, aren't making a profit, and still trading as if they're in 2021. Until these ones either get delisted or go bankrupt, clearly there's still a lot of huge speculative money flying around that really needs to be completely gone before we see a true market bottom. Michael Burry, the famous investor who was featured in the Big Short film, tweeted last month there are still too many companies who were valued at more than $10 billion, yet only made less than $100 million in earnings before taxes, depreciation and amortization. On a complete tangent, he did just tweet this new one. Not sure why he doesn't know the answer. You could just go to Wikipedia and see how tall he is. Pretty sure that's what he meant. And finally, layoffs. We're just starting to see the cracks appear now in big tech as companies like Mark Zuckerberg's Meta, Uber, Microsoft, and very publicly Twitter all got rid of lots of staff. Companies went crazy hiring during the pandemic and throughout the last couple of years as there weren't enough talented engineers on the market, so everyone was competing and throwing money around with stock options as if they had unlimited supplies of funny tokens. Sounds like FTX's business model. And whether or not this is a sign to come or whether other industries are going to start giving their employees the boot, who knows? But of course, the more people out of the job market with no income will likely mean that less money's been spent out there in the economy. And of course, all of that has a knock-on effect in companies' earnings and profits. Okay, so where does that leave us? Are we joining the bulls or are we joining the bears? The answer is really, it depends on where you are in your investing journey and what you want. For long-term investors, I don't think this changes anything if you keep investing regularly into broad, low-cost index funds. If anything, times like these give you a discount on your average cost, and we're nowhere near all-time highs, so consider this a dip. Even if it turns out to be a bull trap, trying to time the market definitely is a loser's game. And remember what we said before, missing out on just a few days like we had last week could really hurt those long-term gains. Now, for individual stock picks, and of course we need to think differently and be really careful about our expectations. If we stick with companies who have strong moats, great balance sheets, and a product that people really actually need, then we might get rewarded if we buy them at some prices on sale. I'm sure in a few years' time we'll look back at some of the companies in the S&P 500 and wish we'd invested more of our money. Which ones exactly? Now that's the real question. I still think big tech has plenty of opportunity for growth, and the chip manufacturers have really been hit hard as good examples, AMD, Nvidia and TSMC especially, who funnily enough, Warren Buffett just announced a large stake in. So does that signal a bottom? Should we now jump in because one of the greatest investors of all time has started to make some more buys? Well, maybe, but either way, strong stomachs will win in the long run, but not everyone will make it. And I do think a lot more of those speculative names from the last couple of years who are yet to turn a profit will either go bankrupt or get acquired and broken up for just a few cents on the dollar, a lot less than they were trading at just a little while ago. Anyway, let me know your thoughts below. Are you holding in cash still waiting for that entry point even with the big rally days behind you, or are you already all in and keeping with the plan? Leave me a like on the way out, subscribe for much more, and as always, happy investing.